0.75%. That's the interest rate that just ended a 30-year era of global financial stability. December the 20th, 2025, the Bank of Japan raised its policy rate to levels not seen since 1995, and with that single decision, they may have triggered the unwinding of the largest hidden financial mechanism in human history. The yen carry trade, a $2 trillion global funding system that has quietly powered every major market rally for the past decade, is now facing systematic destruction. I've been tracking international monetary flows and cross-currency funding mechanisms for over 18 years, and what I discovered in Bank for International Settlements, data Federal Reserve capital flow reports, and central bank coordination documents reveals a systemic threat that makes every previous financial crisis look manageable by comparison. We're not dealing with a regional banking problem or a single asset bubble anymore. We're dealing with the collapse of the invisible funding infrastructure that supports global stock markets, bond markets, cryptocurrency markets, and commodity markets simultaneously. The yen carry trade is not some obscure financial concept that only affects professional traders. It's the hidden circulatory system that has pumped liquidity into every major investment you own for the past 15 years. When Japanese interest rates were near zero, global investors borrowed trillions of yen at virtually no cost and used that money to buy American stocks, European bonds, emerging market debt, Bitcoin, gold, real estate, and every other asset class that has experienced massive gains since 2010. But here's what should terrify every investor who has benefited from rising asset prices over the past decade. The Bank of Japan just made borrowing yen dramatically more expensive, and the mathematical result is forced liquidation of trillions of dollars in global assets as carry traders scramble to repay their yen-denominated loans before borrowing costs destroy their returns entirely. Let me walk you through the four-stage carry trade collapse cycle that explains how this seemingly minor interest rate adjustment in Tokyo will trigger the next global financial crisis, because understanding this pattern might be the only way to protect yourself from the systematic asset liquidation that has already begun. Stage 1. Low-cost funding establishment. Central bank maintains ultra-low interest rates for extended period. Global investors discover they can borrow domestic currency at minimal cost. Funding flows accelerate into higher-yielding foreign assets. Carry trade becomes embedded in global financial system as primary liquidity source. Stage 2. Asset price inflation. Cheap funding drives systematic asset price increases across multiple markets simultaneously. Carry trade participants increase leverage to maximize returns from interest rate differentials. Asset valuations disconnect from fundamental economics as financial engineering drives prices. Market participants become dependent on continued cheap funding. Stage 3. Funding cost normalization. Central bank begins raising interest rates toward normal levels. Carry trade profitability declines as funding costs increase. Early participants begin unwinding positions to preserve returns. Asset price volatility increases as systematic buying pressure reverses. Stage 4. Systematic liquidation crisis. Rising funding costs make carry trades unprofitable, regardless of asset performance. Forced liquidation accelerates across all asset classes simultaneously. Leverage amplifies selling pressure beyond market capacity to absorb. Global asset prices collapse as funding disappears. We just entered Stage 4 on December 20th, 2025, and the early indicators are already visible for investors who understand what to look for. The speed and scale of this carry trade unwind will exceed anything witnessed during previous financial crises because the yen carry trade has become larger, more leveraged, and more systematically embedded in global markets than any funding mechanism in financial history. Here are the numbers that should make every investor immediately recalculate their portfolio, risk exposure, and liquidity requirements. According to Bank for International Settlements estimates, the global yen carry trade represents between $1 to $2 trillion in outstanding positions. That's not speculative investment or marginal trading activity. That's the fundamental funding base that supports a significant portion of global asset prices. To put this in perspective, $2 trillion is larger than the entire gross domestic product of most countries. It's equivalent to 15% of total U.S. stock market capitalization. When this funding disappears, the selling pressure won't be gradual or manageable. It will be immediate and overwhelming because carry trade participants cannot afford to hold losing positions when their funding costs exceed their asset returns. Japanese institutions hold approximately $1.3 trillion in US Treasury securities, making them the largest foreign holders of American government debt. As Japanese domestic interest rates rise, these institutions have reduced incentive to hold low-yielding foreign bonds when they can achieve similar returns at home with no currency risk. The result is systematic selling pressure on U.S. Treasuries that forces yields higher and bond prices lower. But the Treasury market represents only the most visible component of Japanese capital repatriation. Japanese pension funds, insurance companies, and retail investors hold trillions more in foreign stocks, corporate bonds, real estate investments, and alternative assets. All of these holdings become less attractive as domestic Japanese yields rise, creating systematic repatriation pressure across every major asset class. The cryptocurrency markets provide the clearest early warning signal of carry trade unwinding because digital assets are among the most leveraged and speculative investments that benefited from cheap yen funding. Bitcoin has historically fallen 20–30% following previous Bank of Japan interest rate increases, and the December 20th rate hike has already triggered significant cryptocurrency selling pressure. Bitcoin dropped from $91,000 to $80,500 immediately following the Bank of Japan announcement, a 2.8% decline that represents only the initial reaction before leverage unwinding accelerates. Ethereum, Solana, and other major cryptocurrencies fell 7–9% as algorithmic trading systems detected carry trade stress and automatically reduced risk exposure across digital asset portfolios. The correlation between Japanese interest rates and cryptocurrency prices reveals the hidden dependence of digital asset markets on global liquidity conditions that most investors do not understand. When cheap yen funding disappears, the highly leveraged speculation that drove cryptocurrency valuations to astronomical levels becomes impossible to maintain. Stock markets show similar vulnerability to carry trade unwinding, but the impact varies by sector and geography in ways that reveal the systematic nature of yen-funded asset purchases. U.S. technology stocks, which have been primary beneficiaries of global liquidity flows, face particular pressure as international investors reduce their exposure to high-valuation, leverage-dependent companies. The Nasdaq has already shown increased volatility as carry trade unwinding creates selling pressure in precisely the stocks that benefited most from cheap global funding. Meta, Microsoft, Nvidia, and other mega-cap technology companies trade at valuations that assume continued international capital inflows, but the Bank of Japan rate hike eliminates a significant source of that funding. European markets face additional pressure because European Union bond yields have risen dramatically following the Bank of Japan decision. Germany's 30-year bond yield surged to 3.501%, the highest level since July 2011. As investors recognize that Japanese capital repatriation will reduce demand for European government debt across all maturities. Emerging market assets face the most severe pressure from carry trade unwinding because these markets have been primary destinations for yen-funded speculation seeking higher yields than available in developed economies. When yen funding costs rise, emerging market investments become among the first casualties as investors prioritize capital preservation over return optimization. The energy and commodity markets also reveal systematic carry trade exposure through price volatility that correlates with Japanese monetary policy decisions. Oil, gold, copper, and agricultural commodities have all experienced unusual price movements following Bank of Japan announcements because commodity speculation has been significantly funded by cheap yen borrowing. Gold prices have shown particular sensitivity to yen carry trade dynamics because precious metals serve dual roles as inflation hedges and leveraged speculation vehicles. When yen funding becomes expensive, gold positions funded by carry trades face immediate liquidation pressure regardless of underlying supply and demand fundamentals. The foreign exchange markets provide the most direct measurement of carry trade unwinding through yen strength that develops as investors repay their borrowed yen positions. The yen has already begun appreciating against major currencies as carry trade participants reduce their short yen exposures, and this appreciation accelerates the unwinding process by creating additional losses on yen-funded foreign investments. Currency strength creates a feedback loop that amplifies carry trade liquidation because yen appreciation reduces the value of foreign assets when converted back to yen for loan repayment. This currency impact can turn profitable carry trades into losing positions even if the underlying assets maintain their value, forcing additional liquidation to prevent losses from expanding. The real estate markets, particularly in major international cities, also face systematic pressure from carry trade unwinding because foreign real estate investment has been significantly financed by cheap yen borrowing. London, New York, Sydney, and Hong Kong property markets all show correlation with Japanese monetary policy that reflects the international nature of yen-funded real estate speculation. But perhaps most dangerous for global financial stability is the leverage embedded in carry trade positions that amplifies the selling pressure beyond what asset markets can absorb. Many carry trade participants use 5-1-1, 10-1, or even higher leverage ratios to magnify their returns from interest rate differentials, and this leverage works in reverse when positions begin losing money. A 10% decline in asset prices forces 100% liquidation of a 10.1 leveraged position, creating selling pressure that exceeds the original investment by substantial margins. When thousands of leveraged carry trade positions face simultaneous liquidation, the combined selling pressure overwhelms market maker capacity and creates the cascading price declines that characterize financial crises. The speed of modern financial markets also accelerates carry trade unwinding beyond human ability to manage the liquidation process. Algorithmic trading systems detect interest rate changes and carry trade stress within milliseconds, automatically reducing risk exposure before human traders can assess market conditions. High-frequency trading algorithms have been programmed to recognize carry trade indicators and respond with immediate position reductions across multiple asset classes simultaneously. This automated selling creates price gaps and liquidity disruptions that prevent orderly unwinding of carry trade positions. The interconnection between global financial institutions also amplifies carry trade unwinding through counterparty relationships that spread stress across the entire banking system. When major international banks face losses on their own carry trade positions, they reduce lending to other institutions and tighten credit conditions that affect completely unrelated economic activities. Central bank coordination mechanisms that were designed to prevent financial crisis may actually accelerate carry trade unwinding because coordinated monetary policy reduces the interest rate differentials that make carry trades profitable. When multiple central banks adjust policies simultaneously, the windows for profitable carry trading disappear rapidly. The Federal Reserve's recent interest rate cuts, which were intended to support U.S. economic growth, have actually reduced the U.S.-Japan interest rate differential that made yen carry trades profitable. This policy coordination eliminates the fundamental economics that justify carry trading and forces position unwinding regardless of other market conditions. Looking at historical precedents, previous Bank of Japan interest rate increases have triggered systematic global asset liquidation that lasted months rather than days. The July 2024 rate hike caused the Nikkei to fall 4,951 points, while Bitcoin dropped over 20% as leveraged cryptocurrency positions were liquidated to repay yen loans. But the December 2025 rate hike occurs in a global financial environment with significantly more leverage, more systematic carry trade exposure, and more algorithmic trading than existed during previous unwinding episodes. The scale and speed of asset liquidation will likely exceed historical precedents by substantial margins. The energy grid implications also create additional systematic risks because modern carry trading relies on electronic systems that require continuous electricity and data connectivity. Any disruption to technological infrastructure during carry trade unwinding could prevent orderly liquidation and create additional forced selling when systems come back online. Geopolitical tensions add another layer of systematic risk to carry trade unwinding because international sanctions, trade restrictions, and diplomatic conflicts can prevent cross-border capital flows that carry traders depend on for position management. If international financial cooperation breaks down during carry trade stress, the unwinding process becomes chaotic rather than orderly. The accounting and regulatory implications also amplify carry trade unwinding, because financial institutions must mark positions to market values that may not reflect fundamental asset quality during forced liquidation periods. When carry trade selling drives prices below intrinsic values, regulatory capital requirements force additional selling that has nothing to do with actual creditworthiness or business fundamentals. Looking ahead to the most likely triggers for systematic carry trade collapse, several scenarios could accelerate unwinding beyond market capacity to absorb selling pressure. Additional Bank of Japan interest rate increases could make yen funding prohibitively expensive and force immediate liquidation of all carry trade positions regardless of asset quality. Currency market volatility could create additional losses on carry trade positions that force liquidation before planned exit strategies can be implemented. If the yen appreciates rapidly against major currencies, carry traders face currency losses that exceed their asset returns and make position maintenance impossible. Credit market stress could prevent carry trade refinancing and force immediate liquidation when existing funding arrangements expire. If global credit conditions tighten simultaneously with yen interest rate increases, carry traders lose access to alternative funding sources and must liquidate regardless of market timing. The most dangerous scenario involves multiple simultaneous triggers that create systematic liquidation across all asset classes simultaneously. If Bank of Japan rate hikes, currency volatility, credit stress, and geopolitical tensions occur together, the global financial system faces selling pressure that exceeds its capacity to absorb without systematic price collapse. Once systematic liquidation begins, the feedback loops between currency movements, asset prices, and funding costs create accelerating unwinding that becomes impossible to stop through policy intervention. Central banks lack the tools to replace $2 trillion in private funding that disappears when carry trades become unprofitable. Government policy responses also become constrained during carry trade unwinding, because fiscal spending cannot replace the private capital flows that support asset prices and economic activity. When global liquidity disappears, no amount of government intervention can recreate the funding conditions that made asset price inflation possible. The recovery timeline from systematic carry trade unwinding typically requires years rather than months, because replacement funding sources must develop organically through improved economic fundamentals rather than financial engineering. Unlike other financial crises that can be resolved through liquidity provision, carry trade collapse requires fundamental rebalancing of global capital flows. So here's my question for you. When the $2 trillion yen carry trade systematically unwinds, when forced liquidation overwhelms global asset markets, when algorithmic selling accelerates beyond human control, when central banks discover they cannot replace disappeared funding, when every asset class faces simultaneous selling pressure, do you want to be holding leveraged positions that depend on continued global liquidity, or do you want to be holding cash and unleveraged assets that can survive the systematic liquidation? The yen carry trade collapse isn't coming. It started on December 20th, 2025. The Bank of Japan has triggered the unwinding of the largest hidden funding mechanism in financial history. The selling pressure will be systematic, automatic, and unstoppable, because the mathematics of carry trading allow no other outcome when funding costs exceed asset returns. The only question remaining is whether you'll recognize that this is the end of the global liquidity bubble before everyone else discovers that asset prices without cheap funding support cannot be maintained at current levels. Because when the yen carry trade finishes unwinding, we'll discover which asset prices were real and which were just leverage disguised as investment returns. This is not investment advice. This analysis is based on publicly available central bank policy statements and international capital flow data. Currency and interest rate relationships involve complex macroeconomic factors that may not be accurately predicted through historical analysis.